because I hate having to follow that really great presentation. Wasn't that fantastic? Really, I mean, shows how it gets done, how easy it can work. I think it was really spectacular. I'd offer one comment on that before I get into my own remarks. Is, the knocking on the doors and getting the door slammed in your face, and then the emotional reaction from people that if I really show what I've got here, they're going to take my money away. As we know, I don't think it's fully the implementation of this that's the issue. I don't think it's even the cost or any of those things. I mean, it's certainly on people's minds. You're dealing with an emotional issue. You're dealing with a certain fear factor with this. What that is, we heard a little bit of it. I'm sure there's more of it. Maybe people are afraid that they're going to be shown that they have mistakes, and they're going to fear that they're going to be shown to be incompetent, which we know is not the case, but it's maybe real in their minds. Maybe they're fearful that they are going to have money taken away, although that's an easy counter, because you can simply say, look, the more organized you are with your finances, the more likelihood you can apply for grants, the more likelihood you can defend not only the success of your programs, but why you should have more money to continue with the successful programs. So I think as we think about how to integrate XBRL, and we think about, or technology agnostic, I believe is the phrase people are using these days. As we think about how to integrate this in, and we think about the folks that we're trying to work with in this and collaborate with this, give some thought to what their emotional state is as they're looking at something new. People don't like things that are new, and they don't like change. Eradicate those from any sort of persuasive speaking they're going to have. If you say to someone, I have something new that's going to change your life, what's your reaction? Oh, no, I won't say that. Yeah, no, you tense up. It's part of who we are. So as we're proposing this and we're slowly building this out, as you talk to people about it, keep that in the back of your mind. I know we're a lot of finance people here. We're all numbers folks. But keep in mind that there's other things that may be going on as people are asking these questions. There's the message, and then there's the meta message. All right, fine. So let's talk a little bit about the muni market. Let's talk about the SEC Rule 2A5, Rule 3A4, pricing, and how that works with standardized structured financial reporting. Have I lost anybody yet? The SEC people are like, what? We're involved? We're here? Yes. You'll see how this all comes together, I promise. So here's one component of the muni market, are investors. And what kind of investors do we have? We have institutional investors, mutual funds, insurance companies, banks. We've got retail surrogate investors, and separately managed accounts, wealth advisors, that group. And then we've got retail, market term, which is individual investors, and usually buying through a broker or through a brokerage account with that. And if you want to see what the percentages are as to how this breaks out, you can pull this up on the MSRB website, but I believe that the retail buyers still make up about 50% of the market, but the institutional buyers have been growing over time, particularly the mutual funds, which now have about 900 billion I mean, it's a staggering, the market's 3.9 trillion. It's about 900 billion in assets under management. It's concentrated in about 10 of those funds with that. So the mutual funds really drive the market in a lot of ways, particularly with pricing, because they are predominantly the ones buying the new issues when they come out. Keep that in mind. So each of these investors and the subcategories within them, because mutual funds have a lot of breakdowns, there's state funds and there's high yield funds and there's short funds and long funds and every variation thereof. Each of these have different investment parameters, and they're managing their portfolios differently based on what their client base wants. So what does this matter for issuers? Well, for issuers, it's really pretty important because from an issuer perspective, they really want to know the type of investor that's looking to buy the bonds, because that kind of investor is going to influence the ultimate rate that's going to get paid. That's also affected by the size of the bond issue, couponing structure, but it's also based on perceived risk and perceived liquidity. Perceived risk and liquidity. But all of these investors have one thing in common. They all want to know what their bonds are worth at the end of the day. What's the value? What's the price? particularly if you're a mutual fund holder, because there are millions of mutual fund shareholders that have their net asset value share price valued at whatever those bonds are priced at. So here's where Rule 2A5 comes in. And if someone from the SEC wants to correct me on this, please do it afterwards. In brief, it refers to the 1940s Act that say securities in a fund, and that includes bonds, must be fair market valued. That is the term that's used. Fair market valued with a consistent methodology to back up how they come to that value, how the fund comes to that value. Rule 31A4 refers to the record keeping of the fund, which I read through a few times and it's kind of loose. I would have a looser interpretation than maybe others would with it. But that record keeping also stuck in the back of my mind because I'm wondering, well, how are they actually keeping track of these prices and is it actually accurate? That's called foreshadowing, by the way. So the question is, how are these bonds being priced? Well, the funds, and candidly just about everybody else in the market, is relying on an independent pricing services, such as ICE, Bloomberg, to value the bonds they hold. Pretty standard and customary with that. So where's the problem? Sounds pretty good so far. We've got issuers, we've got investors, it's getting priced independently, and we've got fair market. But here's the problem. We've got a $3.9 trillion market. How many bonds do you think actually trade in that market? Institutional size, that's a 1 million bond block or more. Say 10% of the market? Yeah, about 10 you're thinking? Anyone want to go for 15% of the market? You know you want to say it. There we go. Yeah, you're both wrong. It's 1/10 of 1%. 0.10% in 2021. And again, you can go on the MSRB site and pull up the fact book. It's right there. That actually trade in institutional size. Ouch. Now you're beginning to see the problem. So there's a lack of trade data. You've got all these bonds outstanding. You don't have a lot of trading in them. So there's a lack of what is called price discovery. Price discovery is simply saying, oh, that traded, that's my bond. It must be the same price. Or, oh, that traded, it's kind of like my bond. The comp trade, comparison trade, comp trade, that must be the price on my bond. But at the end of the day, there's not a lot of liquidity. It's more liquidity by appointment. It's not my phrase, but it's true. We also have a lot of odd lot trades. Those are under 1 million, usually under 500,000, 100,000 here, 20,000 there, going through. There's a lot of those as smaller, quote unquote, retail trades go through. And that's great. There probably is somewhat better liquidity with those bonds because they can trade on the electronic platforms. But those trades don't move the market. You trade your 25 bonds. You're feeling pretty good about it, got a good price. So what? The pricing services are not going to move millions of dollars of bonds based on a 25 bond trade or a 100 bond trade or 125 bond trade with that. Even if it ultimately aggregates up, which usually it doesn't because these are small pieces trading up and back during the day. All right, well now we got a problem because we don't have a lot of trades, we don't have a lot of price discovery. So wait a minute, what is going on? And for the record, I'm not picking on the pricing services, they're doing the best job they can. But it also means that over 99% of the bonds in this market are being valued by extrapolation. It is, my words not theirs, a sophisticated guess, which it is, based on interest rates, yield curve moves, comparable trades, credit spreads. It's not a black box. I mean, you can see what the methodology is, but it's kind of, to my mind, a dark gray box. Because essentially the pricing becomes an echo chamber. It's self-referential. There's no true objective benchmark other than AAA yield curve, really. Because if something is valued here and something is valued here, and you say, well, I'm going to extrapolate it to here and to here and to here and keep going forward. Where's the truth in all this? Where's the fair market value? I'm not hearing anything fair in here. I mean, the price represents some value. Certainly represents value off of the yield curve, and we can price bonds off of that. I mean, every first-year MBA student learns that calculation. I teach them, I teach it at BU, and they seem to learn it fast enough, and then they can't get it right on the exam, but I digress. But again, the price represents some value, but it's not fair market value, at least not to my mind. And this is why the word opaque is usually used to describe municipal bond pricing. It's opaque pricing because who knows what it is? Who knows what your bond is really worth? Okay, fine, you've gone down this far with the rabbit hole with me. Let's keep going. So how does all this fit into standardized structured financial data? Well, keep in mind that the muni market is a credit market. The bonds are also pricing in risk factors. Now, they're usually assessed by whatever the rating is from the credit agencies, you know, S&P, Moody's, and Fitch. And they have a very extensive framework for that, and very well thought out. I know it's, you know, a lot of times we hear people picking on the rating agencies. They make for an easy target, but since I have friends there, I can't say anything. But I thought they'd get a better response. No? Liz, come on. I'm sorry. But the ratings, remember, are not forward-looking, and they're not probabilistic. But when you're investing, credit risk assessment is both. What's the likelihood of a credit improving or decreasing or weakening? And what's the probability of that happening? Because we're forward-looking on this. So, okay, to my mind anyway, here's where standardized financial data with a consistent taxonomy comes to the fore. Because if we have that, it would provide the ability to create an apples-to-apples risk assessment ranking. Because it's a consistent taxonomy. I can look at a government here, I can look at a government here, I have a consistent band, and I can make some comparisons between the two numbers. Now, we have a lot of good data people in here. You know where I'm going with this. If you can do it for 2 governments, you can do it for 10. You can create a pool, and you start making a lot of comparisons, and then you can start ranking them against any number of metrics you want to have, because you're all talking the same language. And now you can move into certain revenue bonds as well. You can look at, I mentioned hospitals, but you can do water and sewer. I mean, you can do pick any sector you want, as long as you have apples-to-apples comparison, pretty close. I'm not talking about, it doesn't have to be perfect, by the by. I mean, I'd rather be right at 90% than kill myself to get to 100% and never get there. But it offers this risk assessment and ranking. You can compare the borrowers, you line up various metrics, and now all of a sudden risk assessment is not just whether something's single A or triple A. And for the record, I don't really like those ratings anymore. I think they're anachronistic. I mean, no one's going to give up triple A. I mean, folks in the city of Columbus will come here and beat me to a pulp. But what I would like to also see is I'd love to see ratings with a number next to it. It's, for them, AAA, 100. They hit all the metrics, everything's great. We know the metrics work because we can apply we can apply statistical analyses to them. So we know where the strong points are and where the weak points are and what might be probabilistic or what we can predict potentially strengthening or weakening. Or something could be AA, single A, but with a number next to it. Triple B 75 versus triple B 78 or 74. I know I'm dreaming, I know it's not going to happen, but boy, wouldn't it be great to have something that was quantified and was not just simply a letter rating? Just putting it out there. So risk assessment becomes robust, becomes refined, it becomes a truly standard measure. It's based on quantifiable metrics, not just a single rating. right, now that you have that, now you link that to pricing because you've quantified the risk measure. So, okay, great. Bonds will still have a large component that prices off the yield curve. They're fixed income instruments. It's what they do. But now that I have the risk quantified, I know to some degree, a high degree of confidence, that it's adding this much value or detracting this much value. Maybe it's a stronger credit, maybe it's a weaker credit. Because now that I've got the standardized risk assessment, I also feel that I've got a true and fair risk premium or discount that can be factored into that price. Now what happens? Since I'm off in my dream world, we'll keep going. Well, this market suddenly becomes far more efficient, doesn't it? Because now we've got prices that are actually based on objective measures. We've tested what the risk parameters are. By the by, defaults in the municipal bond market. Anyone want to hazard a guess how high the default is? It's okay, don't worry. You can leave the check at the door. Anyone have an idea what the default rates are in the muni bond market for, say, an investment grade general obligation bond? You want to go with that 10% again? No, you do not. Wait, I'm sorry, is it? It's pretty close. It's unbelievably tiny. It's far less than 0.5%. The likelihood, and you can check this number, the likelihood of your investment grade general obligation municipal bond defaulting is roughly the same as you being struck by lightning. I am not kidding. You can back the number up, go onto the National Weather Service, go to the Moody's report on this, and compare what the probabilities are. That tells me that bid-ask spreads should tighten, that credit spreads should be far tighter, that market liquidity improves, that the small issuers that everyone is always concerned about benefit dramatically because now they're getting real value because it doesn't, the likelihood of default is low if they have a number that quantifies their rating, doesn't it? Because the market now has better and more accurate information, it can also make better valuations and better decisions. So I'll close with this. If you want a true fair market value, 2A5 compliant, if you don't want to have a fight the next time over whether munis are high quality liquid assets or not, if you want better liquidity in the market, more accurate pricing, if you want issuers who want lower rates and to get the best new issue pricing they can with lower liquidity premiums and tighter credit spreads, then the answer is very straightforward. Report your finances and other key performance and operating data in a structured taxonomy with structured data, so we all know what's going on at the same time. Look, folks, at the end of the day, technology wins. XBRL is technology. You can draw your own conclusions as to how this is going to play out. And fight it all you want, and delay or foot drag. Much better to get on the bandwagon and start figuring out how to ride. Thoughts, questions, parting shots? Are there any questions?
One question.
We have time for just one. Good.
I know, I'm sorry.
No, I don't dye my hair. There you go.
Yes.
I'm an X-rating agency. Instead of a letter grade, wouldn't you rather see a issue-specific default probability and recovery rate?
I wouldn't mind seeing both. I'm not saying throw away the letter grades. It's not going to happen in the market. The muni market is a lot like Fiddler on the Roof. Tradition. So we're not getting rid of those, and I understand why. It makes for a good, quick rule of thumb, and people can judge it. But yes, I would like to see some probability based on some objective standards. And I promise you, with that kind of default rate, everything flattens, liquidity goes up. Any other thoughts? I know I only had one question, but I'll let it out. But you can always ask me afterwards. All right? Thank you very much. I appreciate it. Thank you.